Chapter number 9, Introduction to Microeconomics, that is concept of revenue of a firm. So again, we have already discussed the various concepts of cost and cost curve. So it will be similar with that one, but here we are going to discuss mainly concepts which is based on revenue of a firm, pertaining to firm, those concepts which are pertaining to a revenue of a firm. We have discussed in general the various concepts and terms for cost, but here specifically we are going to discuss about the concepts which we use in the firm for the revenue of a firm. So a producer or a seller, producer or seller of any goods or any commodity, they are very much concerned with the demand. So demand is important for a producer or a seller. So they are very much concerned with the demand for any commodity. So mainly why? Because revenue obtained by the producer or seller depends on the product, depends on the demand for the good. So the sell or the selling of a product by a producer or a seller depends on the demand of a consumer, or what type of demand will determine what type of produced or what type of product is sold in the market. That is why for a producer and a seller, demand is taken very seriously, because what type of commodity is produced or sold in the market depends largely on the type of demand that they face. Therefore, they are interested, a producer or a consumer is interested in knowing what sort of demand curve faces him, what sort of demand that they face. So the demand curve of the consumer for a product is also the average revenue. So the demand curve is the average revenue. So the demand curve of the consumers for a product is the average revenue curve of the producer or a seller from the standpoint of sellers. Since the price paid by the consumers is the revenue that the producer or a seller gets. So the demand curve is basically nothing but the average revenue curve from the seller point of view, because whatever is paid by the consumer is the revenue for the producer or the seller. So that is what we have to discuss, the various concepts of the revenue of a firm. And besides average revenue, there are other concepts of revenue like total revenue, the marginal revenue. So we shall explain all these concepts of revenue and their relationship with each other with the elasticity of demand. So the first concept that is in our hand is the average revenue. So when it comes to the concept of revenue of a firm, the first concept that we have to discuss is the average revenue. And to understand what is average revenue, you have to understand what is total revenue. In short, it is TR. So price paid by the consumers for the product, they form the revenue or income of the seller. So price paid by the consumer is the income or revenue for the seller of that commodity, of that product. That is what we mean. So the total sales value received by the seller, from selling a given amount of product is called the total revenue. So what is total revenue? Total revenue is nothing but the total sales value that the seller get from selling a given amount of product is called the total revenue. Whatever value that he receives on selling the total, amount of product The total sales value is the total revenue. Whatever he gets from selling that given amount of product, the total sales value is the total revenue. So, for example, if a seller sells 15 units, of a product at rupees, rupees 10, then what is the total revenue? Total revenue will be 150 because 15 into 10 is 150. So that is the total revenue. So the total revenue is equal to the price multiplied by the quantity of output that is produced. So total revenue will be equal to the price which is paid or which is sold, the price level which is sold, and the quantity, the amount of quantity that is sold, and that we will obtain the total revenue. So 15 is the number of units that is sold, and rupees 10 is the price. So when we multiply these two, the price and the quantity of output, then we will get the total revenue as it is. TR as it is, TR is the total revenue, and P is the price, and Q is the quantity of output that is sold. So that is total revenue. So on the other hand, the average revenue is the revenue earned per unit of output. So when we talk about average, it is per unit of output. So the average revenue is the revenue which is earned per unit of output. So average revenue is the revenue which is earned per unit of output. We are not totaling all the product which is sold, but the revenue which is earned by selling per unit of output, maybe 1 unit, 2 unit, 3 unit per unit of output. So average revenue can be obtained by dividing the total revenue by the number of units produced and sold. Thus, average revenue is given by total revenue divided by total number of outputs that is sold. Total output that is sold. So in short, AR will be equal to total revenue by Q. So this is the average revenue, the revenue which is earned per unit, and it is not the total product, but per unit of output, the revenue earned per unit of output, that is the average revenue. So AR is the average revenue, TR is the total revenue, Q is the output. So from the above example, when total revenue was 150, when total revenue was rupees 150, then what will be the average revenue? So AR equals total revenue 150 divided by the total number of output that is sold is 15 unit is sold. So we have here 10. So the revenue earned per unit will be 10. So the 10 is the rupees 10 is the average revenue earned per unit of output. So now the question is whether average revenue is different from price. That is, whether average revenue equals to price. So whether these two concepts mean the same thing or not, let us see. So the answer here is, if a seller sells various units of product at the same price, if a seller sells the product at the same price, then average revenue would be the prices. So average revenue will be equal to price when the seller sells all the products at the same prices. But when he sells different units of a given product at different prices, then the average revenue will not be equal to price when he sells it at a different price. That is the answer. So an example will make it clear whether, as stated above, when the seller or producer sells the unit of product at the same price, then average revenue will be equal to price. But when a seller or producer sells the same unit at the different price, then average revenue will not be equal to price. Let us see this. So suppose a seller sells 2 units of output at rupees 10 per unit. So he's selling at the same price, rupees 10, rupees 10. Total revenue will be 20 because total revenue is price into quantity. So it is 20 rupees. So since total revenue is 20, then average revenue will be total revenue by the divided by number of output. So it is 10 here. So the average revenue is 10, and even the price is rupees 10 here. So average revenue and price is the same when he's selling at the same price. Second example, let's see. When he sells 2 units A and B at a different price, one is at 12, one is at 10 rupees. So the total revenue will be 22 because total revenue is price into quantity, which is price is different here. And what we have is 22 rupees. 12 plus 10 is 22. So total revenue is 22 here. And average revenue would be the total revenue divided by the number of quantities that is produced or sold. So 22 by 2 is 11. So here price will not be same with the average revenue because a seller or producer is selling the different output at the different prices. That is what we mean. So that is all about average revenue. But in actual life, we find that different units of produce are sold by different seller, sold by the seller at the same price in the market, except when he discriminates and changes different prices for different units of goods. So discrimination of price would mean selling the same price at a different, selling the same product at the different prices. That is in case of discrimination of prices. So actually in real life, we use the same prices for the same product, except when a producer or a seller is discriminating prices. So average revenue therefore will be equal to price in reality. Thus in economics, we use average revenue and price as synonyms, except when we are discussing price discrimination by the seller.